Okay, so the first quantitative easing was really expected to bring hyperinflation into the economy, and really what we saw was completely the opposite of what the market expected. And how many times have you seen that in the past of what everyone believes is going to be the case, exactly the opposite happens? It's really one of the only truities in the market. So what happened was the world, even though the credit crisis originated in the U.S. dollar wound up being the safe haven. So the more bank write-downs that happened, the further deterioration we saw in economic data, the stronger the U.S. dollar became. So that bore the inverse relationship of higher equities, lower dollar. And even leading into the second quantitative easing, which is scheduled to be released in 2 weeks, we're still seeing the same relationship play out. You're seeing a relationship of higher equities, lower dollar, lower equities, higher dollar. So we're even seeing an example just yesterday as we're at the FX Street conference. China raised interest rates by a quarter point. Stock markets sold off. You see the dollar rally. I think if the Fed takes the current size of the balance sheet, which is 2.3 trillion, brings it to 3 point whatever trillion, the velocity of money, meaning how much people are taking out from underneath their mattresses, in their money market accounts, wherever people are storing money, they're just not lending it. It's just not being borrowed. It's not being spent. It's not being invested. It doesn't matter how much money you inject into the system, without that money turning around, which is again called the velocity of money, without that money being moved within the economy, inflation will not be the result. And I think it's too early to write off the relationship of an inverse dollar equity relationship. So I would, any signs of risk aversion heading into November, I'm going to look for that same relationship to play out. You're seeing a pretty amazing run up right now in the commodity markets, excuse me. I think it's an example of a buy the rumor, sell the fact situation. The markets are being bid up. The commodity reflation trade is being bid up in anticipation of inflation, but we're just not seeing it right now. So I think if the Fed were to fail to deliver in anywhere in the scale or the size of quantitative easing, perhaps the program is going to be spaced out too long, over too long of a period of time. The markets are going to sell off in reaction to the data. So I would look for the holding of this inverse equity relationship to continue into 2011 and 12.